From the morning reading, spiders, diamonds, IWM, and the Qs closed below the low of the high day. 2 of 9 sectors moved higher on Tuesday. XLU, XLP, and XLV were the strongest sectors, while XLE was the weakest sector. Oil futures fell $2.42 to close at 46.86. Breadth weakened from the prior session as decliners led 22.26 to 8.10 on the New York Stock Exchange and led 18.95 to 7.03 on the NASDAQ. Consumer staple and real estate stocks continued strong on Tuesday as the broad market pulled back, with the SPX leaders and a whole host of DHR, EXRO, PSA, KR, DLR, HUM, and others pouring it on. The S&P 500 managed to recover from a sharp sell-off. It dropped several percentage points over a short period and then rallied just as strongly and quickly. When coming near a high, such behavior has led to further gains in the medium term. One odd aspect of the rally is that bonds and gold are rallying too. It has been extremely unusual to see these markets rally so hard together. There have been only a handful of times in 40 years that the S&P 500 has been near a 52-week high, while bond yields were at a low and gold near a high. Silver suffered a big reversal on Tuesday. After some holiday gains, it reversed more than 5% off its high on Tuesday, scoring a 52-week high before doing so. Other similar reversals have led to follow through to the downside all 9 times it happened. The sell-off in wheat has pushed optimism to an extremely low level. The optimism index in that contract is below 20 for the first time since March. Over the past couple of years, readings below 20 have coincided with exhaustive selling pressure and a rally in wheat over the next several weeks to months. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:34 a.m. Mountain Time, and I'm recording this in preparation for the market day of July the 6th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And fairly active in the overnight last night. At the time of this cut, the S&P futures are down some 12 points, or over 0.5%. Russell futures are down even more sharply at over 0.75%. NASDAQ futures down about 0.2%, and the Dow futures were down a little over 0.5%. Crude oil continues weakness, down over 1%. Euro up just over scratch. Bonds up about 0.25%, and gold is up about 1%. In overseas action, it's mixed, with China up about 0.33%, but Hong Kong is down about 1.25%, Japan down nearly 2%, as is Germany, and the United Kingdom is down about 1.6%. And macroeconomic reports for the U.S. today of note, we have the ISM non-manufacturing PMI, the FOMC meeting minutes. And then looking forward to tomorrow, we have the ADP non-farm employment change. And the weekly version of the unemployment claims. Crude oil inventory. So that's a switch this week because of the holiday on Monday. That's moved back to Thursday. And then you have natural gas kind of in its usual place on Thursday. So be aware of that if you are a commodity trader. Then the next thing is to keep in mind, on Friday will be another major report. That'll be the monthly employment report that'll be looming out there. So that's the next big thing that traders will really be focused on. In terms of current volatility, we ticked up a little bit yesterday. Short-term VIX to a 14.2, skew just barely in the warning status at just over 125. IV percentiles very, very low. These came down very quickly with the vol crush that occurred last week. The S&P is down to a 17, the Russell a 28, the NASDAQ a 16, the Dow a 13. I suppose it could be said these actually ticked up slightly yesterday with the weakness, but their relative position is really, really low. We did have standard deviation moves put in on 3 of the 4 indices yesterday, all but the NASDAQ. We had -1 standard deviation move. So you just keep putting this together, and especially for the Dow and the Russell, you know, you've got 1, 2, 3, 7 out of the last 8 trading sessions have had at least a 1 standard deviation move. So that's a significant amount of volatility. Now, the odd thing is that it's not really being priced into the VIX. I mean, there's not a lot of fear in this market right now. In fact, we'll go ahead and go to that chart. But to have 7 out of 8 sessions with a standard deviation move and not to have the VIX any higher than it is pretty remarkable. So other than the event wrapped around Brexit, which was quickly nullified in the markets, you know, you had the panic, but then you very quickly resolved that panic and went right back to where you were. And we can look at the regular charts here. Let's go ahead and go to the S&P. If you take out the gap up before people actually knew what the real results were, but if you say that the cash participants finished, let's use the SPX for this analysis. So the market finished when you had all players at about 2113. You drop to about, we'll call it 1990. And then we came back all the way to 2109. So within 4 points on the SPX, which is nothing, you came back over 90%. So totally absolved this entire Brexit panic. Before, obviously, you would expect to have some weakness after such a big move. And so we're giving back a little bit right now. But bottom line is that Brexit was basically wiped off the chart in terms of its impact, because we're right back where we started from, especially if you look at this as the day before. You know, these people here are running the market up in anticipation of a vote that they think is going to be good for the market. But if you take this the day before the vote, you know, look at where we are. We're right back where we were. So the bottom line to all this is that, you know, we thought we knew what it was, and then when we saw it, we didn't recognize it. But then when it was all said, we're right back to where we were. So when you take a look at these markets, what are we? Are we bullish? Are we bearish? Ask those same questions in the very short term. Well, you basically had a binary event in which you could have short-term answered that way either way, but when it's all said and done, if you were to just take this and look at weekly candles, look at that. That's this week so far, but that's last week. You know, it looks a bit different when you look at a weekly candle, doesn't it? So the thing is that this is just sideways, range-bound activity, and we haven't resolved anything yet. So when we're talking about the area of resistance that's above us, it's still the same area of resistance. We tapped that in the overnight of the Globex session, you know, from yesterday. And then, you know, this has been weak since. But we were weak before Brexit. You know, this activity before Brexit, we were just basically having bounced off this area of resistance and kind of doing the same sideways consolidation. So we're just right back into this area between, you know, relative levels of support where the bulls are willing to support this, and we've seen this over and over again in recent weeks. At the same time, we we have an inability to actually achieve anything in terms of new highs. Many people consider this, the second longest bull market. But the fact of the matter is that high that established this current bull market hasn't been challenged and reset since last May, over a year ago now. So we have to actually set a new high for all this time since last May to count. If we do roll over into a bear market correction and a business cycle phase that is a bear market, then the top of this current bull market will be defined as last May. So we have to take that out if we're going to be able to defend this current bull market and have any expectations of moving higher. And that so far has proved to be a very, very tall task. Let's go ahead and move forward with the Dow. Dow, of course, very high correlations of late. Looks very much the same. This isn't always true. I mean, there was a period of time here where we're talking about the defensive nature of the Dow, outperforming, and of late they've just been marching in lockstep. NASDAQ, one of the things that does worry me is we continue to see these lower highs, and here we now have 4 lower highs on the NASDAQ. Obviously, the brick set gave us a lower low. We'll see where this next one goes. But at least in terms of the tops, and this kind of continues that thing that we're talking about with these rounding tops, we continue to make, really, if you go all the way back to here into December, after that December high was put on, you've got 1, 2, 3, 4, now 5 major swing tops that have been put in without a break of the prior swing high. And this is going back for months now, 6 months or more, that you've had that pattern in play. On the Russell, it's a bit sloppier. We had a high here, a higher high, but now lower, lower, and with the brick set. So with the Russell and NASDAQ, not quite the same story you have with the S&P and the Dow. They are putting in, what looks to be an increasingly weakening position. Crude oil, of course, was in very high correlation. It broke out of its channel. It went sideways, and right now it's testing the bottom of that sideways channel. If we get a breakdown today that takes out these lows, you have to start saying that something significantly different might be starting to happen in crude oil. And it's hard to believe that our markets, our equity markets, are roaring to the top side and taking out all-time highs when crude oil is doing so poorly. Now, a lot of this is, of course, all related to what's going on in the dollar, as is what's going on with gold. And you look at gold setting in last night's action, a new 52-week high. So safe haven continues to be the story. We look at utilities, continue to be the story. Breakouts to all-time highs over and over again. And then the consumer staples, look at that yesterday on 52-week high, and consumer staples on a day and that the market is weak. We continue to see these very, very defensive areas. And here's Noble. This is the Dividend Aristocrats ETF, and it had a new 52-week low just 2 sessions ago. So it's all about being in the right place. And certainly if you look at what's going on in the trade room, we've got all these kinds of holdings that are dominating our portfolio right now, and especially TLT. Let's go ahead and look at that. And of course, you've got bonds just going crazy, and that's all about safe haven status. Very unusual, in fact, while you had the equity markets, and one of the morning authors talked about this, while you had the equity markets ripping to the upside this last week in the post-Brexit recovery, you also had bonds moving up sharply. So very unusual activity there. We'll take a look at the overnight here and look at this. You know, bonds, new 52-week high in the Globex last night. So this is not the stuff of strong, healthy bull markets. And you should be taking warning signs from all of this activity that this is where the money's going. This is where the institutions are going. It is not in the FANG stocks and the like. They're not holding up. Here's your Amazon. You know, there's no super highs going on there of late. That you have to go back several weeks now to that 731.5. Look at Google. Google's been in a series of lower highs and lower lows even for quite some time. This is not the robustness that you saw in XLU, XLP, gold, and in bonds. So we could continue to make that case for quite some time. We're going to go ahead and move on. Let's go ahead and go to the daily report. Now, one of the things with the daily report we talked about yesterday is this somewhat confused situation with the intermediate term phase opinion. With the weakness yesterday, it's even more likely that this market phase 5 is the correct phase for this point in time. We'll continue to watch and see how these candles play out. But with the huge binary event with the Brexit vote and then the huge reversal of that price action, it kind of made for a very messy short-term pattern. But anyhow, bottom line, we're taking that as a bearish sign. Now, there are bullish signs. IBD went to confirmed uptrend, and that's our first mechanical market timing signal. The GMI index also, though it lost a point yesterday, it's in the second day of its buy signal that was generated on the 7-1 activity. Scoreboard for the decision points is our third mechanical signal, and most recently we've had several short-term signals that have turned positive, but overall this is an absolute mess in terms of being able to find agreement between the three time frames and across the indices. Consensus overall is, wow. You know, I can't really say that there's a strong signal bias here to either side. I think you just call this market in transition, and you have to wait for it to resolve one side or the other. Now, the mechanical signals for position sizing are both at 100%. Take that with a grain of salt right now. These are mechanical signals, and we like to be as objective as possible, but you also have to be able to recognize where is the exposure going right now. And it is not just invest in everything that's moving. This is a very selective market right now, very defensive in its orientation. So if you're at 100%, it hopefully is loaded up with things like TLT, XLU, XLP, dividend aristocrats, those kinds of holdings, and not a bunch of tech and small cap yet. That is certainly would not seem to be called for. On the intermediate term, the market postures turn, strong bull. And indeed, 3 of the 4 indices now are strong bull, with the Russell just barely under the threshold to join the first 3 in the strong bull camp. Now, just to kind of befuddle things again, this is up against a weak bear sentiment line. And overall, we're coming together with all this. So the hedge warning status at a level 1+, which is a caution light. We've been in an elevated risk condition now for quite a number of weeks. It's been a long time since we've been to a 0+ even. And that certainly, when you think about it, 7 out of 8 sessions with a standard deviation move, that's not normal. That is not a normal, healthy bull market. So you've got to recognize that while the price action hasn't actually followed through to either side, bull or bear, in any big way, these are elevated conditions, and this volatility's got to be respected. In terms of strategy opinions, mechanically the VIX is inside the acceptable window to initiate new positions. Just got to, again, keep that in the backdrop of your mind. Position size might need to be dropped a little bit. When you have back-to-back-to-back sessions with standard deviation moves, that makes for many of those option income strategies some pretty difficult sledding. So mechanically, yes, inside the acceptable window for new positions. Price action wise, pretty sloppy patterns here. Cover calls and put selling, much the same kind of thing. We are mechanically acceptable to initiate new positions. At the same time, again, I'd be doing those cover calls. I'd be selling those puts against stocks that I was willing to own, and those stocks would be, you know, utilities and staples and dividend aristocrats and the like at this point in time if I were to initiate new positions. At the same time, you know, we look at our individual signals. A lot of things have gone back to normal status, and the volatility cluster only skew, which is just barely in warning status, is currently flagged as you know, a bearish signal. In terms of the trend base, we still have that kind of messy market phase 5, but everything else is, you know, bullish. Intermarket risk aversion indicators, all 5 are still risk off, though several of these are starting to play at rolling over and crossover, and we could see a change here depending on what happens today. In terms of sentiment, relatively neutral for stock short and medium term. And you see the fear and greed index actually has been you know, somewhat elevated above neutral, but you know, a little bit closer to neutral than it was the previous day. So nothing terribly extreme in sentiment to kind of give us any indication of direction at this point. In terms of sector specific, one of the things we'll talk about, we usually talk about the ones that are holding up the best. Let's look at the opposite today, financials. Very, very difficult for a healthy bull market to persist for any kind of time without the heavy participation of the financial sector. And that is not happening at this time, especially if you were to back out the REITs. The REITs have been hot lately, but they're still in with the financials. And if you were to back out the REITs, the financials would look even worse. So just keep that in mind as you assess things. Materials, of course, again, back to the dollar. Transportation, you know, heck, Dow theory, you know, transportation should be giving you that leading indicator as where the market's going. You know, we sometimes question the Dow theory applied to the current modern global market that's heavily centered on services and so forth. But bottom line is, it's hard to believe that we have healthy bull market as an outcome and new all-time highs when transportation and financials, and for that matter materials, are doing so poorly. You look at yesterday, again, utilities, consumer staples, telecom, the 3 most defensive, the ones that were at the top of the chart. And if we look back here at the 1 month, well, guess what? They're 1, 2, and 3 for the 1 month. So it throughout this period of volatility, and it's not quite a month, but you know, the last 8 trading sessions where we've had, you know, 7 out of 8 sessions with standard deviation moves, especially on the NASDAQ and the Dow, you know, who's performed? It's been these places of relative security and, you know, go nowhere terribly fast most of the time kind of places. So that's enough for today. Let's go ahead and wrap up. I'm going to get to the disclaimers. And hit the pause button if you need more time with the disclaimers. As always, also note the hyperlink down here at the bottom to take you to the full set of disclosures. Manage that risk, and in the meantime, we'll see you back here for the next trading session from Falcon Global. Good trading to all.